Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, I'm Scott Carson, your host, and I'm excited to be joined by two crazy cats that actually, what's funny, it is a small world out there in life. So hang on here. There we go. I'm getting a little background feed there. But anyway, glad to have the two guys from Paperstac join us this morning from Orlando, Florida. Good morning, Rick. Good morning, TJ. How you guys doing today?
Great, man. How are you doing?
Great.
I'm doing wonderful. The Red Bull is flowing through the veins this morning, so we are rocking and rolling. I know it's a little early. It's noontime out there for you guys in Orlando, but it's still morning here.
It's lunchtime here, man. I'm getting hangry.
Well, get the F off then. No.
Yeah.
Don't be getting hangry on me there now. So, hey, guys, for those that don't know you, because we were live streaming this on Facebook, and then we also obviously got our thousands of listeners on iTunes and Stitcher and all the podcasts. First of all, thank you for listening, and thanks for joining us here. But why don't you guys take a quick second and share with our Note Nation a little about who you guys are, how you got started, and we'll go from there.
Okay, I'll take it. I'm Rick Allen. I'm originally from Columbus, Ohio. I moved to Orlando when I was 8, so I'm a natural Floridian. I say the blood is thinned. I don't go back up to the cold.
There's
very
no ice
often.
in your blood?
Yeah. No, I like the heat. I got into real estate in 2005 and started, doing a wholesale thing and actually I met you, I think in 2008 at a wholesaling event that you were doing, or 2009, something like that. And TJ and I met there in 2005 and worked for a nationwide wholesale company, sourcing properties and also sourcing some hard money. And then went into, in 2008, when the market was tanking, we actually decided to open up our own company, which we were fortunate enough to be profitable the whole time, and sold that out in 2011 and sort of stumbled into and stepped in a big steaming pile of notes, if you will, in 2012. And, we haven't really looked back since. And we kind of went in full time and really educated ourselves and put together a little capital. We manage about $6 million right now in capital, and we're in the process of doing our first fund to the SEC, a Regulation A+ fund, when we can do $50 million every 12 months. So it's been a long journey. We've been excited. We also have a company called Paperstac, which is an online note trading platform. So it's been just a lot has happened all kind of in a short amount of time.
Yeah. Thank you, Rick.
Yeah.
TJ Osterman. Thank you, Rick. TJ Osterman from Chicago, Illinois, originally. Been down here about 18 years, I think it is. Timelines are skewed on me. I'm not very good with them, but originally moved down here to be a teaching pro in golf. Quickly flipped my first house and realized, boy, I certainly don't want to work in the golf industry. I enjoy real estate. It was a great time back then to do real estate, and it kind of got me hooked. I really enjoy swinging the hammers, to sourcing private money for people, to wholesaling stuff out. And, what we were doing was a lot of low income housing stuff. So we really got to know that industry a little bit. So it kind of, when we went into the note business, into the low income notes, we kind of, it was an easy transition for us. So that being said, I'm a father. I have, 2 kids.
I always forget to mention my kids.
We see the dad of the year is here.
The last podcast
Dad of the year.
he said he forgot that too, so I had to throw that in there. And I was
Damn it, man.
He's like that. The last podcast he was able to go back and edit, but we're live, man.
We're live.
So, but anyways, so yeah, I have 2 kids, Reagan, who is 4 years old, and Dylan, who is 4 months old. So my life has been really, really interesting since then. I've been married to my wife, Tanya, now for 2 years, and we've been together about
2 years.
6.
Was it 2 years yesterday?
I don't think so, man. Don't throw.
I hope it wasn't yesterday.
Anyways, so we got into the, real quick, we got into the note business and didn't look back. It really changed our whole outlook on things. We saw a whole new opportunity open up. And the great thing about it was we didn't have to pivot too far from the disciplines we learned in real estate, which was great because, there is a lot more stuff to learn, but what it comes down to is the core is you have to understand, I think, the value of what you're looking at, and that these are collateralized by property. You got to look and see what that thing is worth, and to be able to understand and not be afraid So our risk tolerance was a lot more than I would say the average person. So we were lucky in that aspect. And from now on, and now we're ready to keep growing, and we see a really big opportunity here as possibly speculating as a downturn when it does happen in the market eventually, because it's cyclical. We all know it's going to happen. You want to be in a good position to take advantage of something because it's ups and it's downs. And this industry seems to be, you can make money in all markets, bull, bear, whatever it may be. So we're excited, and thank you for having us, Scott. We love your organization.
Yeah, man, glad to have you. So let's talk about it, because I think I had something just dawn in my head here. That I think there's two things that really help transitions. If you're a good wholesaler, and also if you got a mortgage background, it seems those two, and that's not eliminating anybody else. What I'm saying is I think that's the whole kind of gunslinging attitude if you're a wholesaler, right?
Yeah.
And I think you get the fact, okay, I'm going to put something on a contract, go find a buyer. I'm going to put a note under contract and go find a funding source for it, right? Because the deal makes sense. And while I think wholesaling is not bad, I think a lot of people leave a lot of money on the table, especially in the note industry. Would you guys agree to that?
Yeah, for sure. They definitely do.
Oh yeah, for sure.
I think, a lot of times people, they get in there and they just start looking maybe for that diamond in the rough. Like, nope, can't do anything with it. Nope, can't do anything with it. And we're like, you might not be able to, but there's somebody right there who's like, I don't even know, for instance, I don't know what to do with a note. I love notes. I can't find houses. I'll buy the note if you can kind of maybe help me out, show me what to do. JV with me.
It was funny because when we were all buying in wholesale and notes, the REO agent was like the messiah. We were like, oh my gosh, we have to get in and know all these REO agents. And really what it came down to was the bank had all this control over all these assets. And we were thinking, wow, man, if we follow the money and we can become the bank.
It's all about the finance, right? You talked about it earlier. We were going for the REO agents. Now you go for the level above the REO agents, the asset managers. If you could go to the asset managers, it's the same thing. Instead of buying the real estate now, you're just trying to buy the debt.
Yeah. And if you were talking about leaving a lot of money on the table, are you speaking specifically about, like, sometimes note investors will see something and it's kind of scratch and dent, or and they shy away from it?
I'm talking about wholesalers that will just flip stuff basically for like a flat fee.
Oh yeah,
those guys that will just, hey, give me 3 points or give me $500 or $1,000, and they're too scared to approach the people that they're selling those notes to make that transition mentally. Like, hey, instead of me selling this to you, I want you to fund this deal. I'm going to run with it. You're still going to make a great return on investment, because if we go JV partners or a flat return, let's do that. Because I see a lot of wholesalers. There are people that are afraid to pull the trigger. I mean, let's face it.
Yeah.
There's plenty of those gurus running around. Oh, you can wholesale everything. Let's wholesale. Let's drop 5,000 postcards in the mail.
Yeah.
And you've done it. I've done that in the past.
Oh yeah.
That's just not smart investing these days. Would you guys agree to that?
No, it's definitely not smart investing, because that pays you one time. And if you can get somebody to partner with you, and that's how we started. We had a little bit of our own capital. Our first note was a frame duplex here in Orlando. It was $90,000 debt. We paid $8,400 for it. But after we did 3 or 4 deals, we went and showed somebody, said, this is what we're doing. And they go, yeah, I'll give you $1 million. We're on a 50-50 split. And it's like, oh, $1 million? Okay.
Yeah, there's, like you were saying, and now I get kind of where you're headed with that. There's a lot of people out there that if you don't ask them that question, it's almost like when we were selling, like when I was selling timeshare, it was a lot of the people that performed well in timeshare. They asked for the close. They asked for the money. They asked for what they want. And you can't be afraid, because you're actually doing a disservice to that investor or that other person on the other end. Say, look, man, this is what we're doing, and I'm not planning on going away tomorrow. I'm building this business. I'm trying to do a lot more deals in the future, and I'd love for you to come on a journey with me. And
you're doing them a service sometimes by asking, hey.
I think that's the lens you got to look at.
Yeah, you got to look at it and say, not that you're being a burden. You look at it through, man, I'm giving this guy a great opportunity. And far be it for me not to give him that opportunity. I should give him at least a chance to say no. Yeah. And you get a lot of yeses.
So like you're saying, I think a lot of people do. Yeah, I mean, when you charge a flat rate like that, it's you're not really conveying a confidence in what you're doing. It's just like, I'm gonna, we're going to do this and do that, but it's not a confidence builder.
Yeah, it's not like the confidence you get from actually diving into a deal and realizing, oh, hey, here's the strong points of it. Hey, it's actually worth this. Or the homeowners lived in it for 2 years and their rent rate is $1,200 and their existing payment's $700. So it's prime for a good mod and a good statement. And when you know the details, you come from a much bigger confidence level, right? And that is portrayed when you're talking to your money partners. Because I think us coming from the fix and flip side and the wholesaling side, at one point you could basically, and you talked about REO agents, you couldn't throw a rock without hitting 3 REO agents, right?
Right, exactly.
Yeah, right. Yeah.
And now they're rare, and they're also very kind of, well, I'm an REO agent, I'm an heir, I'm still an REO agent, I don't need to do anything, and that's fine. But there's still a lot of hungry people out there that they're looking for deals, right?
And they're not doing anything really.
Yes.
I mean, it's like it's a self-fulfilling prophecy. I mean, they kind of get what they want. But yeah, I totally agree with that.
Yeah. So what's been your guys' main focus? And I know that it's evolved over time, but what's your focus, your bread and butter kind of assets that you're looking at, and what's your kind of your game plan for your guys' note business?
Well, when we jumped into it, it was 2012. People were paying over par at the auction, and we got into it as a cheaper way to buy houses. We were like, let's just get to the real estate. That's so easy. Once we get the real estate back, we know what to do. And then we started kind of talking to the borrowers, and people were like, I don't want to give you my house. I don't want a cited deed in lieu, and I'm going to fight you in foreclosure. And we're like, okay, let's talk about modifying their loan or give them a short payoff. And we kind of evolved into, I don't want the house back now. We don't want the real estate. We're all about saving people's houses and all about that, generating that cash flow. And, at the end of the day, our marketing line for our fund is connecting money with meaning. Is that you can go out there and you can make a really solid double-digit return and keep people in their house. And that, I think that is, it speaks to me, and for him,
oh, yeah,
it speaks directly to his, his mission thesis and where he's going, where we're going together. It's huge.
Well, I mean, whether you care about doing good or not, the bottom line is the secondary market right now, if you have an RPL, is trading at a higher level than an NPL. So why wouldn't you reach out to the borrower if you're getting it at a discount and say, look, man, I don't want to have to take this through foreclosure. The cash burn on some of I just look at our portfolio now, 100 plus assets, and what we cash burn a month on,
foreclosure
for houses in the Midwest. You have to securitize them, winterize them. Oh, it just got broken into. You're getting slammed with
don't forget
code enforcement.
The taxes in the Midwest.
Right.
Yes.
So the point is if you get somebody in there, or you get even a vacant owner, if they, you reach out to them and say, look, you want to keep the home, keep it as a rental or whatever it may be, so we don't have to go through that process. Like I said, if you don't want to do something, the point is that the secondary market are very, very yield hungry. The self-directed market right now, there's $14 trillion sitting in the self-directed IRA 401k market with a bunch of stock market. They call them the stock market refugees sitting out there wanting they're very yield hungry, and RPLs are the perfect fit for them. You could sell them some of your payment, whether it be 360 months and you sell 120 months to meet their yield. Whatever it is, the strategy that a note will allow you to do is awesome, especially a performing note. So whatever your intentions are, ours is obviously that impact intention to help save 10,000 families' homes in the next 5 years. But regardless, we're going to be putting out a product on the back end, not only saving, that's going to be awesome for those yield hungry investors. That, let's face it, you put it with the servicer. And
set it and forget it.
And debt service is collected by them. I mean, that mailbox money, boy, I tell you, once we started to get some RPLs and holding them into our portfolio, boy, did that help cash flow every month. I mean, from going straight MPL to trying to take the real estate back, we were like, holy cow, you can only scale that unless you got an unlimited amount of money. You have to start getting some cash flow in. So to pepper it in your portfolio with some RPLs, maybe partner up with, like you said, a JV partner to both of you guys own half of the, if you're getting 400 a month in on a note, split it up, 200, we'll go in on halvesies. There's so many cool ways to do it. So yeah, it's really exciting for us. like I said, we're doing a new fund where we're able to raise up to $50 million a year. It's a Regulation A+ fund, and we're going to be really hopefully bring some institutional, style money to huge gaps in the low income market right now, and spending and in.
Yeah, I would say that's also, we target houses 150,000 or less in value. That's
the scratch and dent loans, the island of the misfit toy notes. Nobody wants.
But that's the thing about that lower balance. I was, did a webinar last night with people. Like, listen, some facts out here. If you're targeting greater than $150,000 homes, there's nothing wrong with that. They're just not going to mod at a high enough rate for you. They're not going to. Your best play of that is to foreclose, and it's going to drag out with a foreclosure time frame. So stick in the sub $125,000 category, because that's where 90% of the inventory is at anyway.
Yeah.
Now, if you look at what your monthly nut is to cover or to help you retire from your JOB, focus on getting stuff that you can get reperformed with cash flow. It's mailbox money. It takes the edge off of having to go out. I got to make so much each month to cover my bills, when it should be coming in on a regular basis. You know what I mean?
I was just looking at a mod today, and I was looking at it and going over with our asset manager. And I was like, oh, we're, the debt on it's like 71, total payoff 95, house is worth 60. And she was like, oh man, we need to mod this person. I was like, well, let me look to see. And I was like, oh, we're into it for 13. I was like, yeah, where can we put the mod? And almost no matter where you put it, you're going to be 20% or higher. So You're like, all right, yeah, mod. And it's so nice to do that. And you say, and then it's always fun. I don't do it often, but to get what if it pays all 30 years out? Look at that number. You're like, holy cow, that's astronomical.
But it's still cheaper than rent.
Yeah.
I'm sorry, but I could
rent.
Every one of ours, 99.9%, I can say to that borrower, saying, no matter what we do here, you're going to have to live somewhere.
Market rent's $800 a month. They're not, where are they going to go? If it's like, look, I'll put you at $450, half of market rent. We're killing it. They're happy.
Yeah, and especially, right now, major issues with lack of affordable housing. There's no funding now because they've just done the corporate tax where they lowered it from 35 to 21%. Thus now, all these corporations that were buying the low-income housing tax credits, that were funding the developers to build low-income housing tax, aren't funding it. They don't need it. They got the great, 14% discount on their tax. Yes. So to talk to the problem of lack of affordable housing, note investors out there in the small space that we're in, you're doing a great service. And, I applaud every one of you that are able to keep somebody in there because, look, man, these people are getting thrown out of their homes and there's no rent available. It's a hard deal out there right now, but, so.
I totally agree with that. That's the great thing about it, being able to really true a win-win and really kind of not only save a family, help to give them a little bit of hope, but you're also saving the neighborhoods too, because you're avoiding the foreclosure sales, you're avoiding that vacant house sitting there and depreciating, and then bringing the property values down across the board. We've all seen that happen. Mm-hmm. Especially in 2009, I had some rehabs that went from being valued at 300 down to 180,000 because of the foreclosures taking place on the block. Mm-hmm. And so that's my next question. We've been through this upswing. We talked a little bit before we came on live about where we kind of thought the markets are going to be going. Where do you guys see the market going? I know you guys live in Orlando. You're in what's the word? You're in heaven. Yeah. Or as I call it, the home of the big rat trap.
The big rat. That's right.
When I originally moved down here, real quick, is I was thinking, oh man, no matter what, if I'm having a bad day, I'm going to be able to go to Disney, just make my day better. You know how many times I've been to Disney? Now with kids, I've been there like 3 times. But literally, I never go there. But no, it's fun. Yeah, it's what we're known for. But go ahead with the market. What you're thinking? Speculation.
Well, obviously the market here is super strong. I see it's definitely still ticking up. It may be leveling off just a little bit. I still think there's areas in like maybe the Midwest in the middle of the country where there's still some room for some growth. And it seems like the affordable housing is definitely the issue in there. So if you can buy houses in that area, you're buying debt in that area. You're buying it still for fairly cheap, that where you can get in there and you can beat the whole rental system, because it's tough to get in there now, especially in Orlando. It's really, really hard to go out and say, I'm going to go buy a rental property and get in there and make those huge cap rates. It's really tough. But to get into the Midwest, you can still do that in there if you're buying the debt, I think.
Yeah. Market wise, it cycles every 10, 15, 20 years. You're going to see something. At 2008 was kind of the last one. Some people that are saying 2018, you're going to start to see some signs of different things happening. And I think we are seeing certain things happening right now. Whether it's going to be a total, bubble burst or crash at the extent that we did see, no, because of the audits that have been going on, that where the assets going into the asset-backed securities are actually now standardized.
I don't think we'll ever see that dip like that for the reasons that happened. I mean, though, I did see some the other day that the risky loans are coming back. So, seeing that in the news, I was like, this is familiar. This is familiar.
That is for sure. Yeah. But the whole thing is that, that the, I was just reading an article today about the attorneys and how they're having to, standardize an auditing practice of the mortgages that they're actually looking at. It'll never be where they'll go back into an asset-backed security and look at all the loans in that portfolio and say, hey, there's 15 of these. There's not even houses here.
It was like, yeah, you can have a loan. You fogged that mirror.
So I'm seeing a turn sooner than later. That's what I'm speculating. And I would say within the next year, 2 years, I think a downturn is going to start to happen. I think that if you're in the note industry and you're in the smaller balance stuff, position yourself now, because banks are very, very big on image, and they do not want, or it's not them, it's their shareholders and investors not wanting them to have distressed debt. And that's why a lot of them will hide it and put it into these, they call them bad banks, and there's good banks. The bad banks is they just distribute the bad debt into these bad bank holding companies, and that's what happens. And so you're gonna, I think, to start to see an uptick when values kind of level out on the real estate, and you're starting to see the arms that they're trying to get rid of the 30 year.
The trade agreement, it all depends. If we see the price in new housing uptick, you're going to see a little bit of a leveling off there. And as the Fed keeps raising the rates, that certainly is going to affect the value on stuff people can't afford as much. So it's interesting.
Yeah, I'm a big believer that it all depends on really where the finance industry goes, because obviously there's a lot of cash sitting out there flush, and hard money lenders. I was talking to a hard money lender yesterday. They're scrambling over each other trying to get their money in the market because there's so much of it available. You know what I mean? And so we're starting to see, though, that subprime lender start to jump up again.
Head out.
17 states now have programs with different lenders that will do 0% down payments, 100% financing, or they'll do the FHA financing, but the bank will donate the 2.5, 3.5 down payment. And that is a recipe for disaster. We're already seeing signs pop up on the outskirts of Austin, the lower, not say lower level, but lower priced markets of $0 down, $500 down. And I'm like, oh my gosh, what the hell? Somebody was talking on Facebook the other day. Oh, I got somebody a mortgage, 95% financed with a 560 FICO. I'm like, that person's not supposed to have a mortgage.
No.
Yeah, they can maybe afford it on a new build now, but the first year when those taxes change, they're going to be in default again.
It's the pressure from when you're a bank and you're a lending institution, you make money out of putting out money and getting fee income that way. And it's the pressure from all the other institutions. So they're all working together to continue to have to put more riskier investments in to keep them at the top. They have to look as though they are doing business here. And so it should be the opposite way. When it actually starts to become a really good market, it should be harder to actually get a loan. But it's the opposite in the world. So we're kind of backwards.
I think there needs to be the happy medium between it's really hard to get a loan. It needs to be common sense, right? You need to look at something, and it always can't be just looking at a number and saying, let's dive deeper and say, does this loan actually make sense? And when we get the common sense,
underwriting.
Underwriting, then that's when I think you get good quality loans, and you get loans that I look at and say, I'd like to buy that loan.
And I can tell you that from an institutional style. Hold on there. That's live TV here.
Live TV. We got a phone call ringing.
Whenever you come to an institutional level, you always have headlines. These guys are wanting headlines, and so they have to. Like Citadel is one of the companies that's doing subprime stuff. I believe they're doing, and look, they were in DS News just this like yesterday. That's headlines. That's for investors in their bank. They like that. They like to see they're doing this good stuff. But right when stuff starts going bad, which it will if you're offering these people the stuff that they're not able to afford, it's quickly pushed under the rug, and there opens that huge gap for the opportunity for good talent to come in and help these distressed borrowers out. Because they're not going to allocate the kind of resources to helping these people, because once again, they have to show that to their investors. And so they're going to say, why are you putting a lot of resources into distressed loan sales and hiring top-notch professionals? Distressed loans are entrepreneurial. Banks are not. That's it.
They did that already. They tried that play of hiring people to come in and handle the distressed loans, and they eventually just packaged them up and sold them off.
Yeah, the only company that's really going to have any success would be like Goldman Sachs, who bought 26,000 mortgages with the intent to do loan mods to reduce their $1 billion fine they got from the government. And that's why they're willing to overpay for those mortgages that sold. Fannie and Freddie, so they bought those. They overpaid for them, but they have cheap capital and they're getting a tax discount. They don't really need to make profits on it. But I still think that leaves a lot of opportunity for the mid guy, the crumbs guy, instead of the war dogs guys, the note dogs guys going out there and carving up stuff or getting a piece of the pie. Are you guys buying mostly one-offs or mini bulk stuff now? What's kind of your focus on target stuff? Because I'm getting people text me, hey, where are they getting these deals from? What's their focus on stuff? So let's kind of move it to that aspect.
We're buying stuff both. We're buying stuff, piecing it together in a one-off situation, and we're buying mini bulk stuff. I mean, not super high, million maybe is the highest. That'll probably all change once the fund is up. When you have those more zeros in there, you can start talking to different people.
Well, and that's the beautiful thing. But when you have a fund and you start, I mean, most of our trades are sub $1 million anyway, and that may be 30, 40, 60 contract for deeds or 30, 40 non-performing notes. That's either from a fund, or we just had a couple students that funded $1 million purchase, but it was a bank portfolio. Like what you said there, second TJ, the bank wanted to get rid of that one lending platform with their subprime borrowers and didn't want to be the bad guy. So they were glad to sell it off.
Yep.
To somebody, let them be the bearer of bad news, and they could save the positive thing. But I think that's where we're this year. I think it's more about the bulk guy. I think it's more about the mini bulk, not such the huge trades. Trust me, you get 25 million, you got to put that money to work. Otherwise, it's burning a big hole in your pocket with the interest rate and the fees off that, right, guys?
Oh, exactly. You want to get money in, and you want to get money right back to work, because money sitting there idle is dead money, and that's no good.
Yeah. Now, you guys have a platform, and I'm willing to bet. Let me take a gander here. You guys love buying, get them reperforming, but those that aren't going to reperform, and so you want to get that money back out and back in to buy more stuff. Is that correct?
Yeah, we definitely want to get the money. If we work on a loan and we can't, like we said, we don't want to take the house back. We want to get in there and we'll let somebody else do that. So we'll definitely utilize our platform for that. But we also right now use that to put out an end product of a reperforming loan that's been seasoned up. And we've actually had on Paperstac, we've had the one-off buyer who's, the self-directed IRA guy, sold a lot of them on there through that. We've also had some institutional buyers who come in there and pick out like, hey, I like the way these 7 of them look. Let me package them up and move. So it's been encouraging.
Like you said, Scott, the regional banks, like these regional guys, or even community banks, they are buying reperforming loans. And it's just when people think they're dealing with institutions, they think they're dealing with like Wells Fargo right away. And it's not. No, I mean, they're looking for cash flow too, because they have investors. Just like I said, why they don't like to show bad loans on their balance sheets are the same reason why they like to show cash flow on their balance sheets. So there are so many opportunities, and the exact number of how many banks there are out there. I don't know. What is it? It's 22. How many thousands?
There's about 25,000 lending.
25,000. Yeah. I mean, guys, that is like insane. And we deal with one bank, just for instance, that they will they're a little bit slower because they are institutional on their due diligence and stuff, but look, these guys are, if you can turn on that, that outlet, they're willing to buy that RPL also.
Yeah. Oh yeah, totally. There's been asset managers I've bought non-performing from, and then I sold them re-performing loans back at they were looking for a 10 yield, a 12 yield on that because they got cheaper money, that they need that to come in and need that type of double digit or close to double digit return to them. But that's the beautiful thing about the note industry. People are buying from each other, selling to each other because everybody has a little bit different makeup of their business or their markets or the cities that they're investing in and stuff like that.
Yeah, we just did a trade just like that where we sold off $500,000 and bought about $500,000 off somebody, and it was the same person, and it was stretched out over a 25-30 day mark, but it was, hey, we'll sell you this, like, hey, by the way, we're looking for something like this, like, oh, that looks good, and it was like, so I almost think that's where the word trade comes from. It's like, hey, you're just trading back and forth.
I think a good thing too for people that are listening out there is look, you sell somebody an RPL and tell them on the back end, look, if you need a liquidity in there, a liquidity clause, or you need your money out, I'm willing to buy that. If it goes NPL, it's going to be at a discount, but I can get you out of your position, and I'd be willing to take it. So, and then get that thing RPL again and say, hey man, when I get this thing performing again, or whatever we do to structure it, you want that product. So that's the cool thing, is being so creative with this stuff. And those relationships are just not that bing. It's like, hey man, let's work these together. We understand you like RPLs. We'll buy whatever. And
I think with that relationship, that's kind of an important thing. You don't, like in the wholesale game, if you burned an REO agent, you were kind of cooked it, you're done. This is a really small, tight knit industry. You have to, if you're going to make a relationship with somebody, you want to keep it good. You don't want to get blacklisted because you're telling somebody, hey, I'm going to close and you don't close. Hey, I'm going to close and you don't close. So I would just you see these people at the expos or at the different events, you see them there. It's not like, there's no face with these names. You see these people all the time. So that's one thing I would definitely let people know is, hey, if you start a relationship with somebody, value the relationship if you're going to go somewhere, because it can lead to many years of business.
And I think that's a big thing. We're going back to the Paperstac. We have to open up conversations about this asset class if we want to build this market. With Paperstac, it's a lot easier way to look at assets. It's a great way to communicate with buyers and sellers. It was born out of, we've been doing this 6 years in the trenches, and it's born out of us going, what the hell did we just do? We just sent $250,000 to somebody. We have no idea. We can't track, through the snail mail and through the email to try to find all the noise through the emails, guys. My email has like 15,000 emails in it. And I'm trying to find a communication I had with the seller going, holy crap, I'm sweating, not sleeping at night. You got to put it all in one place. And that's kind of why we love Paperstac is, we're really trying to, there's a lot of potential with bringing more of a standardized approach, more of a linear type of progression to
Well, it's a to-do list. Yeah. It just, the iteration 2 that was coming out, we launched in September, and we've already done a complete full rewrite on it, and it'll be coming out next month. And we took, the advice and the feedback we got, and it's like, well, let's just make a to-do list. It's so easy. For the person that's never bought a loan, you can get on there and jump into a transaction and say, well, what do I do next? You don't even need to worry about it. It's just you're on a conveyor belt. It'll say, this is up. You got a green light. You need to go do this. Very easy.
Well, for everybody out there listening, as we do this, we have a 5-year time horizon on this new fund, which we can raise up to $50 million every year. And, we're going to put all that money to work. We're going to have a lot of assets being put out through Paperstac to one-off investors, people that are willing to RPLs to NPLs, to working with people on whatever it may be, small pools. So, stay in touch and definitely help, because like I said, it was born out of us 6 years in the trenches and still in the trenches, the worries and why is it so difficult sometimes? And, it doesn't need to be with the technology. Like we were just talking earlier, how technology has leveraged all of us to do stuff that like corporations just 15 years ago were only allowed to do, really. The Jobs Act has allowed us to do a lot more now. So I think it's going to be the time of the smaller investor, man. It's our time to, and smaller investors is like hundreds of millions of dollars when you're talking about, and that's enough for me.
Trillion, right? 13 trillion. Yeah, the $1 trillion.
The $14 trillion question, the self-directed market. Yeah, just that alone. So we're really excited about everything, man, and anybody that's in it. Let's have some fun while we do this too.
Exactly, I couldn't agree more with that. There's lots of opportunities in the market, whether it's up or down. You just gotta figure out what your niche is. You got to learn. I think you've got to network more than anything else with people, and not be afraid to ask questions. But also, if you decide you're going to pull the trigger, make sure you communicate, talk with a buyer. We had an investor who was going to fund a deal that went dark on us on closing. You're like, you're just hurting yourself, man. You're just hurting yourself. Pick up the phone, call me. What happened?
No. Yeah.
You know, just be honest.
That's that same way with the borrowers that we talk to. We put into our workouts this, like, look, if you feel 15 days into the mortgage, real small shop, if you have an inclination that you're going to be late, something happened, worst case is to go dark. We're not going to come at you with, like tigers and rip your face off. I mean, communicate. Can you afford to give us a couple $100 right now? And we'll continuously just talk about it. And I'm telling you, most people want to, there's the bad actors, but most people really want to do the good thing. And they do. They want to feel like they're paying bills. I mean, they really do. And it sucks when you don't pay them. Believe me, it's worse. I've been on that end. It's like, oh my gosh,
exactly.
So same thing with people that are buying notes. You got to be able to perform. If not, just reach out, man. There's plenty of JVs out there to say, hey, man, I'll pick you up from this end.
Or an extension of the timeline. We do it all the time. But reach out. If you need 15 extra days, I could get you 15 extra days if you call. If you don't call, I can't do anything.
Yeah. Good point.
Good point there. Don't stall, just call.
Yeah.
I can see that on the next shirt, man.
Well, I think the next t-shirt is going to be eat, notes, sleep, something like that. Eat, modify, sleep, whatever like that. Live it, breathe it, think of that. The beautiful thing, guys, I think, is this is something we enjoy every day. Every day is different, and you guys would agree with it. Everything's the same, but everything's different. You never know what you're going to walk you to on a daily basis with your borrowers, the stories, the relationships, and stuff like that. And you never know who you're going to talk to. A great example is this call right here. Is met you 2007, 2008 in Orlando. I was out working for somebody else on a real estate investment seminar, and we actually brought in. I came in a week earlier. We found some deals that you guys were trying to wholesale.
Yep.
Under contract, did the due diligence on them, and within 48 hours of that workshop, we flipped them for $6,000 in profit, $2,000 each, something really easy. And all three of those guys that bought, or the three investors that bought those assets, all made money on those deals. And you never know who you're going to run into later on down the road. You never know who you're going to see. You never know who's following you or on your mail list that's not peeking their head up until something pops up. I mean, that's one of the biggest things I love is. Every month we send an email out to our asset manager list. And every month we get an email from somebody. I have no idea who they are. I've never talked to them before. But when I go back into my Infusionsoft, I see that they've been on my list for 3-4 years. And now they've got something. Now they're ready to move.
I mean, there it is, man.
That's what it's all about.
Yeah.
But setting up something like that, obviously you teach your students very well on how to run the drip file. And just, drip file meaning just continuously stay in there. You don't push stuff on because one day, heck, one of them is going to win the Powerball, man. And next thing you know, they're like, hey, Scott, for, just hanging out with me and showing me some good stuff. I'm willing to put $15 million to work. You know what I mean? You never know what you get.
Exactly. So, hey, guys, I think that's a great stopping point for us. What's the best way for everybody to get a hold of you guys? Go to paperstac.com. Is that the best website to go in and opt in?
Yeah, you can go to paperstac.com and reach out to us there. There's you'll see a little icon at the bottom. You'll be able to talk directly to somebody at the shop here. So
yeah, you could go to also our main site, which is cloudcapitalmanagement.com, and you can kind of follow what we're doing with the fund from there because it'll be a link directly to the fund on what our future progress is going to be, because this is going to be one of many funds that we're going to be doing. So reach out to us. My email is tj@paperstac.com, and that's without the K. PAPERSTAC.com. We couldn't get the Paperstac with the K.
They wouldn't give it to us.
Some guy in like Sweden.
Some guy in Sweden. And if you want mine, guess it's Rick at paperstac.com.
We'll post the links in the comments in our blog as well for everybody. So hey guys, thanks so much for taking time out of your busy schedule to join us here and join us on the Note Closer Show. We look forward to talk with you in the future and seeing a lot of your guys' growth over here in the next few years. And that's a very, very big goal to help 10,000 people stay in their home in the next 5 years.
Yeah.
So
that's our moonshot, man.
There you go, buddy. Hey, you missed the moon. You're in the stars.
And go Cubs. Go Cubs this year. We're going to win it.
We'll see you guys later, man. Thanks for joining us.
Thank you.
Thanks.
Thanks, man.
Bye.